How can you get a mortgage with just a 3% down payment? What requirements must you satisfy for this low down payment program? And is a 3% down payment on a home a smart move? We'll answer these questions and more on this, the 139th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, hope you're having a great day. I am sitting in front of my computer screen with two giant monitors, looking at all of the details on what is a relatively new development in the world of buying a home, and that is the 3% down payment, the 3% mortgage. There have been, low down payment programs in the past. FHA is 3.5%. I think it's been pretty easy to get a 5% down mortgage here recently. But now you can get a 3% mortgage. So what I thought I'd do today in today's show is cover that program, why it exists, what the rules are, and then maybe just a couple of comments on whether I think it's a good idea. Should you actually buy a home with just a 3% down payment? So that's what we're going to talk about today. And I will say at the outset that the very first home that my wife and I purchased, which was in 1993, we did so with a 5% down payment. And, things worked out fine. Probably not the smartest move, but things worked out fine. And we've got no regrets, but there certainly are some risks, some significant risks and additional costs. And so that's what we're going to cover today. So here's the deal. When you go to get a mortgage, there are certain rules that you have to satisfy, certain amount of income in relation to the home you're buying, the mortgage that you'll take out, your payment. There could be requirements for private mortgage insurance, PMI, insurance that covers the lender in case you default on the mortgage. There will be rules requiring that you have a certain credit score to qualify for the loan. And here's the thing that I think maybe some folks don't realize is that the individual banks don't set those rules. Those rules are set by the folks at Freddie Mac and Fannie Mae, the quasi-governmental entities that buy up many of these mortgages. Not all of them, but many of these mortgages. Before they'll buy a mortgage, the mortgage has to meet certain requirements. Otherwise, they won't buy it. And banks that offer these loans, they want to sell them. They don't want to hold on to the mortgages for the 10 or 15 or 20 or 30 years until you pay off that mortgage. By the way, even a 30-year mortgage on average doesn't last 30 years. I think it's somewhere around 7 years, maybe as high as 10. I think it's 7. That's because people move, they refinance. Some people pay it off early, but most move or refinance. That's why 30-year mortgage rates are typically tied to the 10-year treasury. Because most mortgages on average aren't outstanding for 30 years. But in any event, they have all these rules that have to be satisfied or they won't buy the mortgage. And the banks want to sell them so that they can get the cash and then continue to make more mortgages. And they're just simply profiting from the fees that you have to pay when you get a mortgage. They take that fee income, sell the mortgage, and get the money back and then go do another loan, another mortgage for another home buyer. And that's not always how it's been, and certainly recent past it is. There are some banks, by the way, that don't sell the loans into the secondary market, as it's called. They hold on to the loans. Those kinds of lenders are called portfolio lenders. They have a portfolio of loans. They lend out the money to buy a home, and they keep the loan. So they don't have to meet Freddie and Fannie's strict requirements. And in fact, when I buy property for an investment, we use a portfolio lender because we can get much better terms. I mean, we've had plenty of zero down loans on real estate, whole different kind of ball game there. But for most folks buying a home to live in it, you have to meet these standards. And so until recently, in fact just a few days ago, Freddie and Fannie didn't offer a 3% down mortgage. You couldn't get it. They wouldn't buy that kind of loan, and as a result, lenders wouldn't make that kind of loan. These low down payments are back. There was a change made, and now, as I said, it was just a recent change. They have this new program where you can, in fact, buy a home with a 3% down payment. And I thought I'd read something to you from an executive vice president, actually, from Fannie Mae, talking about this change. They said, "Our goal is to help additional qualified borrowers gain access to mortgages. This option alone will not solve all the challenges around access to credit. Our new 95% LTV offering is simply one way we are working to remove barriers for credit-worthy borrowers to get a mortgage. We are confident that these loans can be good business for lenders, safe and sound for Fannie Mae, and an affordable, responsible option for qualified borrowers." And by the way, LTV, loan to value, 97% loan to value. So they're going to lend 97% of the value of the home or the purchase price. That leaves you with the 3% down payment. That's what the 97% LTV means. It's interesting if you look at this from an historical perspective. There's always this tension between giving folks access to credit, but doing it in a responsible way. And when the economy is going well, you hear all the politicians and the leaders just clamoring for low down payment mortgages because the banks are unfairly keeping folks who maybe have less income from owning a home, and that's unfair. And then, of course, when the housing market tanks and people start to go belly up and they lose their jobs, and it's maybe some of you have gone through this. It's no fun. I know I kind of lived through this as a child where we almost had our home foreclosed on. But people start to lose their homes, and then the whole conversation changes to those irresponsible banks who lent money to folks who couldn't handle the payments. And that's what we went through in 08, 09, 2010. Now we've swung back around, and now we're back to the low down payment mortgages to help more people buy a home. I don't know what the right answer is. I do know that we tend to take a myopic view of it. And at the end of the day, banks don't set these rules. Freddie and Fannie do. And so they've set the rule 3% down mortgage. So how do you get one? What's required? So the banks, by the way, not all banks have to offer this mortgage. I think most of them will. Why wouldn't they? Although some could say, no, we don't want to. We think this is irresponsible. We're not going to do it. But they virtually all will because there's money to be made, and Freddie and Fannie are allowing it. So, there's no special place to go to get this 3% down mortgage. You don't go to Freddie and Fannie, right? They don't make the loans. Banks do. So you might go to Wells Fargo or Citi or Bank of America or whatever, your local bank. So that's the kind of place you'd go, and they'll virtually all of them will have this. And so what do you need? How do you qualify for this? Well, first of all, it's only available for new home purchases and limited cash out refinances. So these programs aren't available if you own a home now and are looking to buy a new one to move to. You have to be a new home purchaser. Now, if you haven't owned a home, I think it's for 3 years, you can still qualify as it being a new home purchase. But for folks living in a home looking to move to a new place, you're not going to qualify for the 3% down mortgage. It's designed to help folks who don't currently own buy a home. And at least one of the borrowers must be a first-time home buyer. So if you're a couple, at least one of you have to qualify for that. Yeah, if you're going to do a limited cash out refi, your existing mortgage has to be held by Freddie or Fannie. And you could call whoever services your mortgage to find out. There are income limits that apply, and they depend in part on, or they depend really entirely on where you live. So they look at your income compared to the average of where you live. So it's, I can't give you, you need to make X dollars or whatever, but there are income limits. The bank can obviously walk you through all of these. It has to be for a fixed rate loan, not a variable rate. The loan has to be for 15 to 30 years. If there's a mortgage out there for more than 30 years, I think there are every now and again. Anyway, that wouldn't qualify. It has to be a single unit. So this wouldn't qualify on a multifamily unit, and it doesn't apply to manufactured homes. Another requirement, your credit score. Your credit score has to be at least 620. That's the credit score that you need. And, you should, if you've been listening to this show, you should know how to check your credit score. But if you don't and you want to check it out, you can just go to DoughRoller.net/credit score, and that will direct you to a page where I have a whole bunch of resources where you can check your credit score. But you need to have a score of at least 620. Your income, employment, and assets must be fully documented. This is a fully documented loan, which I think most all of them are now, I think. I can't confess to being a mortgage expert, so maybe there's some out there. But, back in the heyday of the market housing bubble, there were a lot of loans made that weren't documented, and these no-doc loans, and obviously it got us into a lot of trouble. So these 3% down payment programs require that your income, employment, and assets be fully documented. Another interesting requirement is that at least one of the borrowers must complete a home ownership counseling program. I guess that's a good idea. I'm not sure. I've not sat through it. It strikes me as a little odd, but the idea is to educate folks on being a responsible homeowner. So if you want to take advantage of this offer, this 3% down payment, you got to go through, at least one of you has to go through a home ownership counseling program. The last requirement, this is important, you will be paying private mortgage insurance. As I mentioned, that's just you're going to be paying the premiums on an insurance policy that protects the lender should you default on the loan. Now, you probably know that if you make at least a 20% down payment, you don't have to pay the PMI. So the idea is that PMI covers up to 20% of the purchase price over the loan, right? And so the theory there is that banks don't need more insurance because in most markets the value of the home is not going to fall below 80% of the mortgage balance. Now, of course, we know that in extreme circumstances it can, but that's generally how private mortgage insurance works. And so if you put a 10% down payment, you'll have a private mortgage insurance, but the premium should be less than if you make a 5% down payment because it's covering a smaller amount. And obviously, the ideal situation is a 20% down payment and you pay no private mortgage insurance. But for this program, if you put just 3% down, you'll be paying private mortgage insurance, and it's not insignificant. And that kind of gets me now, those are the requirements. This kind of gives me now to whether this is a good idea or not. For me, the answer is no. I really would discourage. I think about giving some advice to my kids. I would say hold off. If you've only got 3%, why are you in a hurry to buy a home? Now, I'd want to look at their other finances. Do they have no other debt? That would be a positive factor, obviously. On the other hand, maybe they're swimming in credit card debt and student loans and a car payment. Then to me, it's a really bad idea. I just don't like 3% down mortgages. As I said, we got our first home was a 5% down mortgage, and it worked out fine for us. Probably not a smart move then either. I can tell you we definitely were underwater for a few years, but we had no plans to move, so it wasn't a big deal. And when we sold the house 11 years later, we made a reasonable profit, and so I was happy about that. But these are high risk. When you buy a 3% down mortgage, understand that you're immediately underwater in the sense that when you go to sell the home, you're going to pay more than that, more than 3% in fees. The realtor fees are 6%, assuming you don't try to sell it on your own. There's going to be local and county taxes. You may have to pay some of the closing costs to the buyer to encourage the sale. So from the perspective of what cash you could get if you sold the day after you bought this home, you're already underwater day one. So I think you ought to think hard and long before you go into a 3% down mortgage. If you are going to take advantage of the program, you ought to be prepared to stay in the home for a long, long time. At a minimum, 5 years. I think 10 years is more realistic. So I think they're very risky loans. Again, they can work out, but they can also cause you a lot of pain. And I think the big question would be, why are you rushing to buy a home with only 3% down? Why not save more money? And ideally 20% so you avoid the private mortgage insurance. That's what I would be advising folks today. Yes, it means putting off buying a home. Yes, that's not what I did 20 some years ago, but I've learned a little bit since then, I hope. And I think that's the best way to go. But that being said, I wanted to share this program with you. It's a new program. It obviously does make buying a home more affordable. Affordable is the wrong word. More, I guess, realistic or for folks. I mean, it doesn't change the price of the value of the home, but it allows folks to obviously to get into a home with less cash up front. And so I thought I'd share it with you again. Though, go into these programs with a lot of caution, ask a lot of questions, really think about your finances, the other debt that you have, your other financial goals, and really ask yourself, is this a smart move for me? Should we wait a little bit? Even if you can't get to 20%, even saving a 10% down payment, there's a big difference between putting 10% down and putting 3% down, both in terms of the PMI that you'll pay, but also just in the equity that you have in the home starting out and your ability, if you had to sell that home and to move somewhere else without losing money. So that's my take on the 3% loan. It's there, but I'd use it with caution. Hey, if you have a different view on that, would love to hear from you. DoughRoller.net. Hope you enjoyed the podcast. That is a program. If you go to the show notes, DoughRoller.net/podcast139, I'll have links to a couple of things. You'll find links to the news announcements for both Freddie and Fannie, where they talk about these programs and what you need to qualify. I also have a link to a page on the site where you can actually check out current mortgage rates that would and what those are, and you can. It's actually how I refinanced our home. I went to my own blog and the tool on mortgage rates and found the lowest, clicked on it, ended up talking to someone. We did everything through the mail. When they closed, they actually came to our home. We didn't have to go anywhere. They signed all the paperwork in my home. Very easy, got a great rate. And certainly you can use the same tool to find a good rate on a 3% down mortgage if that's what you want to do. Hey, hope you have a great day. Remember, until next time, the best thing money can buy is financial freedom.